Risk disclosure, trading futures, options on futures, and retail off-exchange foreign currency transactions involves a substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. In no event should the content of this website be construed as an express or implied promise, guarantee, or implication that you will profit or that losses can or will be limited in any manner whatsoever. Today is Wednesday, April 26th, and this is Order Flow Trading, Part 1 of a multi-part series. So I'm making this specifically because I'm day trading a lot. I also have a very good friend of mine who day trades, and I'm wanting to convince him that he should trade futures and specifically learn order flow trading. So order flow trading is, as you guessed it, perfect for day trading because it's fantastic for scalping, which should be synonymous with day trading. It's not the same as positional trading, and it doesn't rely much on hindsight studies either. So what do I mean by that? So we're going to take a look at Fibonacci levels as an example of positional trading. I should also say, for day trading. Oops. How do you like this fancy drawing board that I'm borrowing from my girlfriend? Thank you for her contribution. So usually this falls in the camp of the day time frame of projection. That's usually for a continuation, and also retracement. I apologize in advance for my handwriting because I type and never never write. So let's just get something going for projection, which, as you know, you take a measurement of a swing, and then that becomes the basis for some projection. Right. So, of course, that would be 0%. Then 38.2 comes up very often. And for brevity, we'll get rid of the percentage sign. 138.2. Excuse me. I really like this drawing thing just because it breaks up the monotony of looking at a bulleted outline, for instance. Now, I don't know if you're in a trade using this or if you're looking to enter a trade or exit a trade, but essentially at every single one of these levels, what do you expect to happen? You expect there to be some pullback or reversal, right? So if you're in a trade, so maybe you entered in right here, then you're looking to exit here. And if you're not in a trade, then you're looking to take a reversal trade. Then on the retracement side, exactly the same thing, but the reverse of it, right? In this case, you expect this to retrace back, and you're kind of looking for a bounce, right? But this is your measured move. Maybe if you get the bounce, you project it, and you get projection off of that. But initially, this top is going to be the 0, and then it retraces 38% of the range, 50. We'll go ahead and just round these off. So 62, 61.8, for instance, and then 100. And if you have read Carolyn Borodin's work, she is a fan of the 127.2 for kind of a fall through area for a bounce. But on the way down, so from here, you're looking for a bounce at every single one of those levels. Problem with that, of course, is that it doesn't always go smoothly, right? So let's say you're trying to play a reversal play, or you're using this as an exit, right? So you play a reversal play and it keeps on going up. You know, for instance, ooh, gosh, that's way too thick. Yeah, let's get this down. So nope, and and finally get a reversal play, maybe right here. Ta-da! You know, same thing over here. So let's say you tried to play this, tried to play that, and we'll be nice this time. And well, obviously you can't do that. We'll be nice this time and say that we don't get that fall through, stop out run here, and it just bounces right here for maybe some ranged trading throughout the day, right? But overall, on balance, you have the big problem here of how far will this go? And it can be overall on balance. If you have all these losses, even if you're kind of managing your risk at times, you still have a big risk of having this be an extremely costly exercise. So another thing to look at as far as positional trading goes, next up would be moving averages. So everyone knows, how moving averages work. I mean, this is going to be the overly simplified version of moving averages, but essentially, right, you expect the price to respect those moving averages. So we'll just pretend for a second here that this is the 200 SMA. And the problem with this, of course, is if you're looking for this as a continuation, then maybe you got stopped out here for a bounce and went down below. You got stopped out there. You got stopped out here and here and here and here. But not being completely mean about this. I mean, you do have a nice little rejection here, rejection here, rejection here, rejection, all the way back. So, I mean, you have your wins and your losses, but on balance, it's still kind of iffy, so you still have that that essential question of, how far will price go or test, Also, you have another big problem with this is that all these things are hindsight. So of course, hindsight is 20/20, right? So looking to looking behind, everything is perfectly reasonable, right? Makes sense in retrospect, right? We're all geniuses looking back, but we really have no clue what the future holds, right? It's that right edge. I mean, this is all pretty obvious stuff, yeah? So we'll move on to the last thing, which will be indicators. Sorry for the... and indicators really have their own share of problems here. Really popular ones would be like the RSI. You have stochastics, right? Is it with, I don't think it has anything. Stochastics and maybe MACD, right? These are all really popular things, But for a given stock price movement, So we'll have a stock, and let's just give a nice neutral gray color here. And that stock is moving, and it's kind of, trending. Oh, nope, nope, it's not trending. New lows. It cuts back, and nope, nope, nope. It changes nature. All sorts of weird things, right? And anyone who trades stock definitely familiar with how crazy the price action can be, right? So you have RSI, and RSI might give you, kind of one of these deals, So you have this right there, and RSI is, it's coming down, and then it comes up, and then it comes down, and then it comes up, and then it comes down some, right? But the main problem with RSI is that you are moving up back here, and then you get your signal right there. You're moving down right here, but then you get your signal to move down right there, right? So it's always lagging, because side, right? Stochastics have kind of a different problem, I find. So stochastics, you have your overbought, your oversold, you have your slow moving stochastics, right? And your fast moving stochastics. Oops, it doesn't loop back around. Sorry, my hand slipped there. But essentially, if this just stays up here, do you short? No. It gives you this the very dangerous terms of overbought and oversold, which are both myths. I mean, when it comes down to it, they really are myths. There's no, there's no, with experience, there's no such thing really as an overbought stock or an oversold stock, and that can get you in a lot of trouble. So this is kind of a, strange thing. So people start using these in conjunction. MACD, my drawing's not really good enough for MACD, but in general, yeah, it's horrible, right? In general, I'm not even correlating this up here. The signals are off, so signals don't always match up. Give you mixed signals. I mean, this obviously would never happen, but yeah, it just leaves you still with, that problem. And, the main reason that this is horrible for day trading, again, is, hindsight. And also, I'd say that in addition to that, these are probably better for longer time, but not day trading. Okay, back to reading. This is really big to me personally, as a couple years ago I started shedding many indicators for that exact reason. They're all backward-looking indicators. So I learned Elliott wave theory and Fibonacci analysis, then auction market theory most recently, all of which have aspects that move away from studies, and I should say also indicators and other things. A quick note though, Fibonacci analysis is sort of forward-looking. Retracements are kind of looking over what's already happened. I mean, they kind of are in that gray area. A lot of things are in the gray area. But moving on to day trading, in my experience, if you use traditional charting methods for day trading, there will be many times the short-term price action cannot be explained by a moving average or a wave count or Fibonacci level. Early in the day, shorter-term candles offer a close enough approximation of which side is dominant, buyers or sellers, but as time passes, that relationship drifts until you reach a point where price breaks out pulls back to a seemingly insignificant level. Then after a while, it makes a volatile retracement or continuance, and there was nothing on a time-based chart with some moving averages and studies and indicators that clued you into the why. But order flow methods will fill in those quote-unquote gaps of analysis necessary to make trades with lower risk at levels that don't make much sense otherwise. Quick shout out, my biggest influence in learning order flow has been Peter Davies, but also by asking other futures traders for guidance. I've come across more resources, like there's the Futures IO forum, which is also very popular, so I may give that some exploration soon when I get some free time. But Peter has a whole bunch of videos up on his Jigsaw Trading YouTube channel, and you know, out of respect, I feel I should definitely mention those are available if anyone wants to go and watch them. Maybe my goal as well would be that I convince some other Wall Street IO traders to give this a try and you know, create a little community around some futures on the site. So we'll move on to the next section, which is ground. So let's start out with an analogy. Let's imagine a very tall building. Oops, try this again. There we go. Very tall building here. You know, it has a fire escape on the outside. So we'll have the building. Let's make some floors for this building. All right. And we'll also give it some floor numbers here. Let's start with 78, 79, and so on. And there is a fire escape. So let's draw a little fire escape here. You know, the fire escape has some stairs, right? Yeah, and okay, let's get these going here. And it's a building, so we'll give it some windows too here. Now, I'm not going to bother drawing open windows, but you know, suffice it to say, these windows all open up. So we're going to have a little game here, and in this game there are two teams of boxers. This entire building is full of boxers, right? We have blue boxers, and blue boxers get points for, you know, moving up the stairs, and of course likewise you're going to have red boxers who get points for moving downstairs. And this can be a little bit confusing, of course, because in the course of the game, you know, red boxers can become blue boxers here, you know. So they can switch to this team, and blue boxers can switch teams and go to the red boxing side. So once again, the rules are you get points for progressing levels in your chosen direction. So, you know, if you're chosen to go down, you get, you know, points for moving down each level. And you lose points for getting pushed back. You know, so if you've chosen to go down and you're having a fight with a group of bidders, for instance, moving the price up or the fight up, you know, then you lose each level that you get pushed back as you're retreating here. The windows are just kind of entries and exit points. You know, you can go inside the building, rest up, heal up, whatever, and then take the elevator in the background to a different level and start the game all over again, right? So I like this analogy a lot. As you can tell, I took a little time here to come up with this. For one thing, the boxers, you know, they're not all the same stature, right? So I mean, you're gonna have some little guys, you know, some little boxers here, but then you're gonna have maybe some like big, you know, big boxer dudes, you know, and they're gonna you know, be all super strong. There we go, big boxer dude here. you know, and obviously he's gonna, you know, have a lot of power here. But you know, you can also have just like a whole group of small boxers, right? And those guys, you know, they're gonna have some power in numbers, you know. So you have a big crowd, you can have a big guy here, you know, big player, for instance, heavyweight, lightweights, etc. Um, so here we have the game just started up. You can kind of see this is where the fight's happening right here around the 83, 84. You know, we're trading punches back and forth. You have bidders trying to lift the ask or lift the offer because, of course, they, you know, sellers, you know, kind of go by the term of ask or offer. So you're trying to lift up, you know, but you kind of see there's not a lot of support behind this guy. Not around this level anyway. You have three guys behind him, three sellers. You know, you have more. You know, 5 up here. You got 3 more up here. But look at the bidder side. You only have this one guy up here. You know, there's some action going on. Maybe another guy joins the fight here. You know, he joins the fight, but then as the battle goes on, he battle goes on, he gets knocked out. I guess you can't really see that there, but essentially, there we go. X's. He's out for the count. You know, so what's going to happen after these guys knock out these buyers, for instance? They're going to move. They're going to progress down to the next level. They're going to start over again, right? You know, and let's say that it wasn't a complete victory. Let's say that we had some casualties on this side. So in the fight, this guy, he's gone. You know, maybe we should just go ahead and erase him, right? We lost one guy there, and you know, now we're down, and we have about, you know, a couple guys then reappear. They've made it down here, you know, to fight. You know, so now you have these 2 guys, and they're gonna try to hit into the bid. You know, there's two for 2 here, and these guys see what's coming up here. One of these guys is like, hey, you know what? I don't see a lot of people until I'm up there. I'm gonna go ahead and fight it out. The other guy decides like, I'm gonna get out of the way here and go downstairs and join this team down here. You know, so this guy decides to take the elevator down and you know, go down a level. Of course, these guys, you know, pretty tit for tat kind of game, and the first 2 guys left, they knock each other out, you know, and then this guy, he decides, or he makes it, right? He goes ahead and he survives, and he comes back down, and he's down here, you know. So this guy, he makes it, you know, but now he's up against all this opposition. You have 4 people here, you have four guys here. You see all this kind of liquidity. There's not a lot of guys on the sell side trying to pile in. Maybe you get a couple guys trying to front run that crowd up there, you know, something like that. They start loading up. But in general, you know, you see all this support down here. So these guys are going to fight it out, and then price is just going to oscillate between the 2 areas here until you know, one side or another, you know, eventually gives. Yeah. So maybe this comes down, and as the price progresses, you know, 1, 2 levels here, you know, these guys are thinking like, oh, geez, you know, we're really making progress. Like, why are we staying up here? We gotta move. We gotta get inside and take the elevator down and join up. You know, and well, you know, this guy gets knocked out. You know, so maybe these guys start loading in, and they start appearing down here to kind of take the fight. You know, take the fight lower. They say like, oh, you know what? There aren't really a lot of people here. Like, there's a lot of battling. They've kind of canceled each other out. I think if we, you know, moved in right around here, then we have a chance, chance to really start push. So they start pushing into the bid, and they cancel these guys out. And finally, you're down to this initial area, and you had all these people watching the game here, and you have people that were on the sidelines jumping through the window. They decide to join up with this crew down here, and I'm actually kind of doing this wrong. If you're adding up, you're actually adding up back here, but you get the idea. There's just onward thing, and that way these things progress, and maybe they'll keep on moving up here, and maybe they'll make it all the way up to where that liquidity is up there. But there are a lot of interesting things about this analogy to take note of. For one, during this whole transaction, of fighting and trying to progress, and then maybe exiting through the window with your profits or losses, etc. It's important to know that wherever the current price is, so let's say you have the current price here, say current price, right? All the fighters can actually see ahead of them. So everyone can see how many fighters are on each floor. So going back through here, you have a lot of action back and forth, to start things off. It's a real battle. But eventually, maybe one side gives, and that could either happen because this whole group progresses up, and they finally bring the battle higher, and you kind of see that the value, because of value would be maybe considered wherever there's the most volume happening, wherever most of the fights happening. If the fights keep on happening more often, higher and higher as time progresses, maybe these guys start to worry, and maybe they decide to just exit and head even higher. That's one possibility. So they could just get out of the way, for instance. Another possibility is let's say you have an opportunist, and they see this guy, this group of guys down here, and they decide hey, these guys are coming down, but they're kind of thinning out as they go down. A lot of them just profit taking. They're kind of fading out in strength and numbers. I am going to get in right here. They say I'm going to get in right here where the line is shorter, and then I'm going to take a position, and then it's very unlikely that the few people that are here are going to push through this large crowd. And that's called front running, because one of the little mechanics here is that there is a queue. Oops. So whenever you get into a trade, you are put in line. So these guys are first, right here. And then wherever you were probably last. So you're not going to progress unless some of these people get knocked out, or some of these people decide to bail out on you right ahead of you, and then you progress through the queue, right? And likewise, it's the opposite for the other side. You have the last in line on the edge. Oops, not laying over here, and then in the middle is the first in line, right? So that's something to keep in mind. It's also a reason why I urge everyone to download Sierra charts, and I'm going to end this video by showing you how to get my particular setup, so that you can actually see this happening, all this action throughout the day. You can kind of witness it happening, because if you use toss, just having the battle go up to the floor, it's a first touch sort of model. If the price touches this area, you instantly get filled, regardless of when you put in your order. There could be 800 people ahead of you, and it'll just fill your order, and then it'll turn right back around. But in reality, you never would have been filled. So it's very unrealistic, I should say. It definitely makes it easier if you could just simply go short as soon as price was there, but you can only go long on the downtick and short on the uptick. That's just how it works. So back to reading. This analogy is actually really similar to the price ladder or the trade DOM or dome. So that stands for depth of market. The prices are the floors, or the levels, I should say, because every floor is technically a ceiling, right? You have bidders and sellers. The depth that's on the graph or on the ladder are the groups of boxers you can see either above or below the current price. So if you go back to this picture, I don't have that many floors, but on something like the ES, and I'll just use the ES for this entire video series. On the ES, you can actually see, if you're down here, you can actually see up the fire escape, 10 levels from the current price. So you can actually see at 83, you can see all the way to 93, and at 82 you can see all the way, or I guess it would be 92 technically, and at 82 you can see all the way down to 71, and you can see how many boxers are lined up. In general, the further away from current price, the thicker the market, or the more the more liquidity, you could say, exists up there. And then around the current price, usually there's not a lot of liquidity. Another interesting note is that in times where there's going to be a really volatile announcement, or a potentially volatile potentially important announcement, you'll see that all these players playing the game exit through the windows ahead of that. So you have all that, some liquidity that still exists, maybe even more than 10 floors away either way, but there are just a few stragglers that are brave souls enough to stay in the fight whenever news comes out. And then who knows what's going on in the background. Maybe news comes out and then 1,000 traders just come out on the bid side and start pushing up through, and there's not a lot of resistance until somewhere further up there's a hidden level, and then tons of sellers come and start pushing back down, right? And just you can go up and down tons and tons of floors very, very quickly around volatile news, or I should say tons and tons of levels around volatile news. You also have those windows there, and I put those there just because you need a way to get in and out of the game. If you're entering, that's called stacking, and if you're exiting, that's called pulling. I should say that stacking and pulling has to do with the players that aren't fighting. So they're on the sidelines. They haven't had their limit order filled, for instance, and something happens to make them think like, this is maybe not the right place to be at the right time, so I'll get out. Or you maybe have some people that get a little bit emboldened by what they see happening in the market, and they say, hey, I want to join in, and they start stacking in on one side or the other. Recent trading volume would be the total number of knockdowns scored by either side at any level. So you could think of those as like the participants. The ones that are active would show up in this number of recently traded volume. The bid and the ask trades are always compared diagonally, which is why I wanted to use some sort of staircase analogy. So let's take a look at that, and also remember this little quick note here. Just like I mentioned, there are no such thing as strictly up or down boxers playing. They can switch sides at any time. They can go to the building and then come out on the opposite side for the opposite team, because for them they just want to get the points. They don't care if it's up or down, just whether or not they're making progress. So let's take a look at the price ladder real quick. So this is the price ladder. Of course, these would be the floors or the levels, I should say. These would be here on these two bars. This shows the depth or the liquidity in the market. So you can imagine that on each level here, these are however many bidding boxers want to move up at each level, and likewise you have these are selling boxers, and they want to move down to win their points, right? Pulling and stacking. So this shows how many boxers entered the fight or the game at this level recently, or here, or within 10 levels. You can kind of see that. We had a bunch just show up now for no reason. It's the after hours. This is very, very light. We had a few bidders go ahead and get pulled. They pulled the bidders from that game. And of course recent trading. So tit for tat. They're fighting each other, and some get knocked out, and some progress up. But you can kind of see these are basically trades that are filled at each level here. on the price graph. So I hope that that kind of analogy makes sense as far as that visual goes. And this whole setup is what I'm going to provide at the end of the video. Next up, let's talk about the tape, which is time and sales. I just started reading Reminiscences of a Stock Market Operator, and the main character has an intimate knowledge of the quote board and the tape. I guess whenever he was in his teens, he worked in a bucket shop, which is kind of a street brokerage, you could say, more like a gambling parlor almost. And he would help read the tape and put prices up on the quote board, but that's how he started seeing patterns in the tape. There are apparently still traders who can trade just the tape. It does have technically everything you need. You can see the size of the orders filled and the tempo of the fills and the rate at which price changes, but it's not very easy to absorb this information without lots of practice, and personally my memory would give up after a few minutes of that. I'll also say that the tape changed in 2009. In the past, if a large block order was placed, you would see it only after it was completely filled, so it was easy to see if there were lots of block orders on the tape. Now you can see all of the components of how that larger block order is filled. There were cries of conspiracy whenever that happened, but there's nothing really nefarious about this. One of the reasons the exchanges said that they wanted to change this is because it was using up bandwidth to have orders just sitting on the servers, and they could more easily, more easily just show what was getting filled at any one point on that. So, in the past, for instance, traders would complain that they couldn't tell if a block order was filled by another large party or a bunch of interested parties in that. So maybe you have a block order for 100 contracts to sell. Traders were peeved because they weren't really sure if like another big trader took that order, or if maybe 20 smaller guys came in and filled out all the orders for that block order. So in theory, though, what's still true is big orders should equal big players, and that should equal the side you want to be on. It is possible to use filters to reconstruct the tape. I filter for orders of the same type made at the same time, constituting at least X in volume, some sort of volume. And I also have an unfiltered tape. I see a few block orders filled on the unfiltered tape, but that just means there are large players actively trading. Normally, this only occurs at the edges of prices, or locations, like significant, locations, at significant locations. But sometimes also during stop runs, that can happen. The tape only shows active orders, meaning that the tape, of course, is only going to show you an order whenever it happens. Somebody actively accepting, a buy or a sell order, right? It goes along with the idea that for every buyer there's a seller, and every seller there's a buyer, right? So let me minimize that. On this side, you have the time and sales. This is the reconstructed tape. So you can see, like, I don't have a lot of noise happening here. I think I have it filtered so that this only shows at least 50 in volume for any order that kind of comes in at exactly the same time. And you'll see if I go ahead and put in, for instance, let's load on time. A lot of these orders come in. I mean, this is actually during the after hours, so it's a little bit different. But during the day, excuse me, a lot of these orders come in, within the same few milliseconds, actually, right? So reconstructed tape just kind of pulls those all together and gives you something that's a little bit more readable. These windows I have over here because they kind of float on top of everything else, as you can see. So it's kind of an illusion that I have it as part of this, static in this setup. Let's get back to the outline. So that should bring us to passive versus active orders. Active orders consume passive orders. That's not, surprising there. If you had a lot of limit orders in the market and no one willing to budge, then you'd have no price movement. You can see this on the price ladder as recent trades at a level. Only active orders move a market, as I mentioned. If everyone in the market simply put a limit order to buy or sell at one price, no one would be budged. No one would move. Passive orders can be thought of as resting orders or inventory, but I think liquidity is the best label. Some traders believe that markets are always seeking liquidity, but this is not always the case. Sometimes you hear that markets always chase size, right? That's similar to this. So on the buy and sell columns, which by the way, if you click on this area, it puts in an order, so you don't want to do that. And just ignore this. I was playing around with some crazy orders at the end of the day in sim, and in simulation, of course, managed to pull down 212 ticks, which my account is nowhere near that size, but it's nice to know. Anyway, here you have the depth, right? This is the liquidity that's available, and you could say that there's an imbalance right now at 56 because there are 1,200 orders to the upside and 994 orders to the downside. So the imbalance is 57% of the orders on the total book reside with the selling side. So a lot of traders look at this and are like, okay, well, price is going to move up into that liquidity. For me, I just think it's this liquidity can be responsive at any time, and it doesn't always work out that way. In fact, I would say order flow is order flow, and if price is progressing one way and you have a lot of sellers like stacking in, that might slow down some progress, but ultimately it's going to go where it's going to go. Let's see. Right. So market depth, or the book as it's sometimes called, can be represented as all of that resting volume at all price levels within a range of the current price. And as you can see, you saw it on the graph, yeah, actually you didn't see it on the graph. I can throw in a study here called, I can activate it, called market depth. And here, I'll show it. So market depth is somewhat filtered as well, but basically it shows thickness where there are a lot more orders on the book, and then projects it forward, just to fill in some space here. I don't really actually get a lot of use out of this. I get a lot more use out of it just staring at it like right here during the actual price moves than I do looking up here on this visual reference. So that's why I go ahead and just hide this. Plus you just have a strict number attached to it over here, so it's nice to see that. Okay, put things back to normal. Excuse me. The simple practical use of a depth of market or DOM is to compare liquidity within the range of the current price. If you see just a few hundred orders on the book, and then suddenly there's a level with double or triple the number of buyers or sellers, do you want to put an order where there's low liquidity or high liquidity? In general, you want to lean against that liquidity, but it's rarely that simple. Trading is a game, right? So part of these games, there are things called icebergs, right? A few years ago, you could see more resting orders on the books, but now we have similar daily volume, but fewer orders showing on the book. So more and more, there are orders that are programmed off the books. These appear only when volume is depleted at a price level and then stacked back into that area. So going back to the boxing analogy, iceberg would be if you had a huge secret crowd of boxers that were, on one of the. So this would be like the iceberg. So they're down here, they're hiding in this floor. You can't actually see them, but if the current price manages to move its way down to this level, maybe you have a few knockdowns here. There's the crowd here, X's because they're down for the count, right? But every time this kind of group of, say, bidders in this case gets depleted, then you have a group that jumps through and they're ready to go. And then whenever those numbers get low, then the next group also jumps through the window, and the next group, and they keep on doing that until either the iceberg is melted through, or in most cases, the sellers go ahead and back off, and they go ahead and reload at a higher price, seeing that there's so many participants down here ready to jump in line. In that case, you could say that sellers are getting absorbed because you have all these transactions happening here without any price movement. Let's take a look at this. Next up, you have spoofing, and spoofing is kind of the exact opposite of an iceberg, right? Spoofing is kind of meant to deceive traders into thinking there's liquidity or support on one side of the books. So maybe they see a ton of traders of liquidity on the books, and they think like, oh, maybe that's an iceberg order or something like that. And so they decide like, okay, I'm going to lean up against that and look for a reversal there. But then suddenly, when price gets close, those orders are pulled as price is about to hit. Traders are then they get run over. They're stopped out. So ultimately, spoofing and icebergs are just part of the game. In the ES, for example, you can usually spot it as thick price levels. They're normally about maybe 1,000 to 1,500 orders on the books at any one time. But suddenly, you might see a 3,000 size order on the book, and usually that's too good to be true. It's usually like a spoof. But in the weeks I've traded order flow, I rarely see that at all. So I don't think it's as obvious anymore to spoof. I do think icebergs are a little bit better as far as a gaming mechanism because it plays into the fact that nobody knows if an iceberg really exists there until after the fact. Whereas spoofing, it's like I mentioned, it's overtly obvious that somebody's kind of like spoofing the market, and that there's lots of danger. So if I really want to beat this analogy to death, and I do, spoofing would be like a puppet master. So it's like a little boxer, and he's on strings. He's like a puppet. It's not a real fighter there, but from a distance, it looks real enough. All right. So we have a bunch of spoof orders here. There's puppets on strings, and the guy holding the strings here. Or maybe there's several guys, but usually it would just be a guy there. As soon as the current price, decides to move up towards this area, then maybe you have some sellers that are like, oh, I'm going to get ahead of this, and because I see all these guys here, this army above there, I'm going to get in this for a reversal, and I'm going to make my money that way, or sorry, I'm going to make my points, right? This is still, I'm just thinking this is a game, but then all of a sudden, wham! This guy yanks all those orders out of the way, and whoever was standing there gets steamrolled, and the price skyrockets, right? And so that person, whoever was there, kind of gets completely run over, and they get pushed back all the way up here, and they have to get out for a loss somewhere up there. So next subject is that different markets are thick and thin. Thick markets have lots of liquidity on the books, but it's kind of like walking through mud, right? The price moves very, very slowly. And a lot of bond markets are like that. They'll have 2,000 to 5,000 orders on the book, but the price action itself is just molasses all day. Very, very, very slow. Thin markets on the opposite hand, or opposite side of that, are like moving on ice. So prices slide around past reference points. They stop out people all the time. Then they can just bounce right back. And so crude acts like that. Not a lot of orders on the books at any one time. Yet a lot of volume does trade through the day, so it's it's kind of interesting. The ES is somewhere in between that, so it's slightly thick. It's like walking on pavement. So price can turn on a dime and move in a wide variety of tempos, and so it can be really, really elusive. If you're learning to trade order flow, you might try something like ZN or the tenor, which is the 10-year bond. but I trade the ES, so that's what I'm going to use. So quickly, some slang. Hit the bid is orders, sellers pushing into buyers. Lift the offer or the ask would be bidders trying to go ahead. Bidders buying up limit orders on the sell side. So that's bullish, right? Leaning into the bid, offer, or ask. That's just another way of saying hitting the bid or lifting the offer or the ask. You're just leaning into it. Leaning against that, though, you could have leaning against the order. That's also known as front running. That's when you see a large order on the books and you decide to take a position right ahead of it. If the order size is about 2 to 3 times the normal size, then be very suspicious. Gosh, I can't spell. It's probably spoofing. Icing, iced, absorbed. These are all very similar. Icing or iced implies something over time, and absorbed can happen on a very short time scale. So absorbed is maybe a more broad term, and then icing or iced is just another flavor of getting absorbed, for instance. Reloading, so this can either mean orders stacked into a price or an auction rotation back to a selling or buying area, then reloading for another push. Stripping is the same as pulling orders, so stacking is the opposite of stripping, because you're loading up orders, right? So let's get to the tools. First up, you will need to download Sierra Charts. To get set up, you will need to download Sierra Charts and also start a Rithmic data feed account. To get Sierra Chart, just do a Google search for it. Sierra Chart, skip these ads, and then you can find the Sierra Chart website. You have to create an account. Of course, write down your username and password information. And during the account creation, it'll ask you if you want to download the software, which you do, or you can just go to main and software download. It'll take you to the page where you can go ahead and download whatever current release of the software is. Then we want to go and do a Google search for Rithmic demo. So you'll find this, sign up with Rithmic, and fill out the information. It'll send you an email. Click on the confirmation. And I'm not sure if it asks you to create a username and password again or what, but just be sure to keep in mind your username and password for that, because you also need to do that. At some point, when you download Rithmic, it'll ask you to download Xtrader, Rithmic Xtrader, or maybe it's RTrader. I always forget. And there's like a pro version or regular version. Just get the regular version, and whenever you sign into that version, use your username and password, but also look on the sign-in page for an area where you can select different feeds, because you're going to use, I think, the Rithmic paper trading connection. That's what it's called on that. And then go ahead and log in, see if it works first, and then you can just shut it down. Really, you're just trying to test out the connection itself, a little bit of troubleshooting just to make sure it's all set up. Both of those things, the connection and the charts, have a 2-week trial, so you have lots of time to play around with this. Last piece of the puzzle, though, is before you start up Sierra Charts. Actually, it doesn't really matter before or after, but preferably before. I have a folder on my Google Drive, and I'll include the link for that. Excuse me. And you want to download the Sierra Chart folder. So it'll download a zip file. So go ahead and extract that zip file, and you should get a folder called Sierra Chart. Whenever you get that folder, just drag that folder to the C drive itself. All right, and the reason is you drag it to the C drive. Oh, sorry, it's my computer. If you drag it onto the C drive, then it will ask you if you want to replace all the duplicate files in Sierra Chart, like this. And yes, you do want to replace that, because it'll give you the one data file that I'm looking to use for these presentations, and I'll give you a bunch of the other settings as well. Everything except for my account information. You have to do your own demo account information, of course. Then whenever you set up and start Sierra Chart, you'll have a little login page. The next thing you have to do is either click on DTS here or go up to File, and what that is Data Trade Service Settings. It brings something up like this. You select Rithmic. I think it defaults to SC data or CQG or TT or something like that. But you want to use Rithmic here, so we'll go to Rithmic, and then put in your username and your password. Check connect on program startup, and also on server. You click on this, so you click on this, and it gives you the chance to change these things down below. So click on this, and then you change this to, I have it on a live account, but you would change it to Rithmic 01 test, right? So that's a big, or sorry, not 01, Rithmic paper trading server. Getting tongue-tied here. Paper trading server, and then it'll work correctly for you. So you hit OK. It would start connecting up here, and then we can go ahead and move on to the rest of the CR charts, which I'll start the next video by giving a guided walkthrough of CR charts. Everybody have a great night, and see you on the next video.